Hello and welcome. Good afternoon, evening. We're back. Well, we are back. Too late is too late. He's not here. Jose is still not here. I'm calling him too late right now, like Jerome Powell. So we have 28 minutes before the market closes. So we can talk a little bit about Figma. We can talk a little bit about what's happening in the market. The reason why Google stock is down today. I mean, if you needed a reason, today there's actually a reason why Google stock is down. And then after the market closes, of course, we have Amazon, Apple, we have Reddit, Coinbase that reports earnings, but we are going to focus on Amazon and Apple, more specifically Amazon's earnings call. We do have time until the earnings call, so we are going to go over Amazon's earnings report, Apple's earnings report. Maybe if we have even more time, we'll have a look at Reddit and maybe Coinbase as well. So yeah, first of all, good afternoon, good evening to everyone. We have here, yeah, Jerome Najarro. He's not here. He's on its way. Too late. He's on its way. Okay. In the meantime, let me maybe pull up the heat map. Doesn't look great. I am happy that my chat is working today. So that's already a nice improvement from yesterday. But as you can see, I mean, Microsoft still green, Meta still green. Too late is here. He has finally joined us. Maybe he can make sure that the last 26 minutes of the day, we are going to see a bit more green than red. But it seems like we are seeing red across the board at the moment, although Applied Digital is still up 30%. So we're still on track for our little holiday house in Florida. Meta up 11, Reddit still up 7. So I guess in anticipation of something, or it's a rug pull bound to happen. Nebius is up, SoFi is up, and so the biggest names that are down are still Novo Nordisk, Micron, for some strange reason, Robinhood, New Holdings is down, Intel is down, Google is down. I do have an explanation for that. PayPal is down even more. No explanations for that, actually. AMD is down a little bit. So basically everything, most of the names are down at the moment. Let me just show you something interesting for Novo Nordisk. And then maybe we can talk a little bit about the Figma IPO. So Novo Nordisk, as you can see right now, and you can go back in our previous streams. These lines existed before, and it seems like currently we are at the same price, the same bottom than as for, when was this?
What is
September
this magic?
2022. I don't know if the black magic is going to work this time or not, but the last time we were here, the last time the stock did drop all the way, we didn't have this huge drawdown, but it seems like this price right here has been a bottom. Is it going to be a bottom yet again? Remains to be seen. Like I said in my video about Novo Nordisk, don't expect this to recover, to have a V-shaped type of recovery. This is a turnaround that will take time, and you have time. You have time to accumulate. You have time to listen to what management has to say in the upcoming quarters.
And
Now,
Neil, quick question here. I know you kind of are starting to get somewhat familiar with this health space a little bit more. You talk about Oscar, I feel a bit. You talked about this one, and you talk about the other one, United Health. If there was one that you would say maybe to maybe take a closer look at, any are any of those names that you would?
I mean, I
Would like
own
to.
Oscar and United Health, very small
Mhm,
position. I mean, small compared to the others, small.
mhm,
Um, but like I said, with United, I have time to accumulate. I did buy a little bit more yesterday, so I'm down even more today. But I like the information that I got. I know the recovery will take time, but I do think that there is like a 50% upside in front of us.
mhm.
Not in the
Yeah.
next month or so, but if I can choose now a stock when the market is at all-time highs where it does present 50% upside, even if it's in the next 12 months or so, in the
Yeah, that's
meantime,
still really good.
in the meantime you do get a dividend, and there might even be more upside.
Mhm.
You just need patience, and that's why it's still in
Yeah.
accumulation mode or just a small position. I do have Oscar, but since Oscar is a very small company market cap wise, um, for future potential, if they do reach their own targets for 2027, then this can become a multi-bagger. But here again, high risk. I'd say the reward is also quite big, but I don't want this to be 5, 6, 7% of the portfolio, even if I
And
think it can become bigger.
again, this is a market I have no idea where it's from. If maybe you can give me like maybe a quick liner of each of like, because I feel like I've always hear Oscar. Oscar is kind of like that growth future, super multi growth potential if things go right. Then I kind of have like the United being like the more mature player, I guess. Um, but I don't know. Like obviously the healthcare market is big. Do they all operate in different segments?
Now, so your healthcare industry is very complex. So you have your Obamacare, ACA, you have your Medicare, you have your Medicaid. Oscar is more focused on, well, they are going to grow more in the individual market, and they have a lot of exposure to ACA, which apparently subsidies are going to expire later this year. Again, there are some rumors and talks that it might get extended, might not, because a large chunk of people that do benefit from those subsidies are Republicans, funny enough. Um, so we'll see what happens with that. But Oscar is more exposed to that. United Health is more exposed to the Medicare Medicaid side of things. Of course, United Health generating $400 billion in revenue makes them, I think, the largest health insurer in the world. Um, so they all play in the health insurance market, but they play in different segments, of course, different sizes as well. So United Healthcare, for example, they have two divisions: the United Healthcare one, and then Optum. Um, Optum focuses on delivering healthcare services, technology, and data-driven solutions to providers, payers, and patients. And I did see today that an analyst downgraded United Health on the risk that Optum, that side of the business, might be under pressure because of some, I don't know, V28 risk or whatever that was. Haven't really read the whole thing. Um, but yeah, with all the changes happening right now, with most of these companies reporting higher medical loss ratios, higher cost, most of them are going to raise their prices in 2026. It's you have to understand it's a whole pyramid. Like if hospitals have operating margins of nothing, like a 0 to 5% maybe. And so if they see that, well, things are getting more and more expensive, if they see that people come in and they don't even have insurance, or maybe they're undocumented, for example, to operate that business, you will probably need to raise prices. So if they start raising prices and they start charging people higher prices, of course, then you have the insurance players that are saying, oh, okay, we now have these types of claims and suddenly everything's becoming more expensive. So we are going to take a hit right now, which is happening with United Health, Centene. Their medical loss ratios are higher, their margins are coming lower, their profits are coming lower. And so next year, what's going to happen is that, well, since this is a business, they need to make profit. They're going to increase prices. And so things will get a little bit more expensive. Remains to be seen what can be done with regards to AI, technology. How can you streamline all of this? Make sure that data is on your side. Some people will say, I know Chris Patel had a conversation on X about it. Some people will say, oh, just be transparent, have transparent pricing for hospitals, and so we'll know exactly what's happened. Ideally, yes. But then you will. It's like it's a two-edged sword, because if you do that, then people will say, oh, this hospital is more expensive than the other, and so you will not go to one hospital, and then that hospital won't be profitable anymore, and that hospital might close down, and so you have one hospital less, which means you have less competition. Less competition would mean that the others that do survive will raise their prices. They raise their prices, everybody's raising their prices, and the money coming out of your pocket is going to be larger and larger. So it's a whole system that needs to work well together. Hopefully, with the help of AI and all of that, it can happen. But bottom line here also is that you need a healthy society. And unfortunately for you guys, the United States is not healthy. It's not me saying, it's the data. The United
Mind your business, Neil. Mind your business.
I mean, look at obesity rates, men and women, from 1960 to 2023. This is not good. Okay, this is not good at all. Maybe Ozempic
It's like
fixes
my
this.
stock portfolio. That's a good thing.
Yeah, the stock portfolio, yes. Maybe, I don't know. Maybe Ozempic does fix this or not, but yeah, this doesn't help your whole healthcare system at all. And
Thank
so
you for that, Neil.
I don't know what I wanted to say, but
You just wanted to do a whole long stream so you can call us Americans fat. That's it. That's Neil. I was actually I was looking over. You mentioned Micron was down a nice amount today, right? We saw kind of about a, what is it, 4 or 5% drop. And
for two,
what's it
two,
for?
two, two.
Two.
No,
All
no,
right,
no, no.
$4.
Wait. Yeah, no, now 5%. Yeah, 2% for the week. Sorry.
Okay. I was looking. Samsung reported earnings last night or early this morning. I don't know how, because obviously they're overseas. But they did mention a few things. I'm kind of looking at their some of the transcripts here. They first mentioned that for HBM3E supply actually has grown faster versus demand. So they anticipate supply demand dynamics to change, which will likely impact market prices for the time being. Now, obviously, this is kind of the current driver in memory markets right now. It's obviously the HBM3E, as all these players have kind of talked about that. They also mentioned that Samsung warned that competitive dynamics in HBM would pressure profitability, obviously because of kind of the with the supply and demand curve. Considering the upward pricing momentum for conventional DRAM so far, the second half, based on current signals, we believe the difference in margins between HBM3E and conventional DRAM is expected to narrow sharply. But they are saying that the pricing of DRAM itself is actually increasing from the consumer space. So that's kind of going to narrow the gap. But it does seem like there's just a little bit more competition in this HBM3E space. So I wonder if a lot of analysts are running with that and creating kind of this negative pressure for Micron, at least at the moment.
Okay, but I mean, I don't know. The trend for Micron should be positive, and for some reason it's not. But we've seen that before, and then suddenly they release their earnings. We'll have some time because they released that in June, and suddenly we see, oh, actually they are growing quite rapidly, and HBM is still growing rapidly as well. So I don't know. I don't know what the market needs to see there for Micron, but another company where I do have an explanation now why it is down, and that's our favorite company, and that's Google. And Google, let me just pull this up. Google is down today because why not? It's down 2.4%. You would think that Google would be up more because of their own earnings report and Meta and Microsoft earnings report. But no, what does pull Google down is that they failed to win the appeal against Fortnite parent company Epic Games in the App Store case ruling. So they lost its appeal in an Epic Game lawsuit in which a judge previously ruled that the tech giant has to revamp its App Store policies due to anti-competitive practices. So it's all about that 30% fee, the same as Apple. Basically, Google told news outlet that the decision will significantly harm user safety and undermine innovation for Android. Google's VP for regulatory affairs said to Bloomberg, our top priority remains protecting our users and developers and ensuring a secure platform as we continue our appeal. So I guess it's not over, but it's another loss here for Google. And we know that we still have that case, that DOJ case. So I guess that's why. The stock is down right now, because I didn't see anything else Google related for the day other than this. When I saw this, I was like, okay, I guess it does make sense. It does make sense. Yeah, stock is down because they lost here their appeal, but I guess you can appeal even more and more.
Yeah.
And so that's what we're getting here.
For Google, this is one of those that is just, I think the market is just pricing the negative way too high, but the bullish sentiment is still pretty exciting for this stock.
I have here something else. Amazon stopped spending on Google shopping ads, apparently. That was yesterday. The report said that ad buyers who monitor Google's auction insights, a tool that provides them with a view of the top 10 advertisers and share impressions in the search environment they're bidding in, regularly saw Amazon's name. But since last week, the e-commerce and tech giant has not been visible in auction insights. Okay. I don't think we have seen anything in Google's earnings report that would suggest a big hit. So that was Google. Then we have Figma.
This one's wild. I can't believe this is crazy.
We just have one. You would just have one candle here. So let me put the maybe hour.
This is wild.
So Figma just went public. The price of the IPO was supposed to be $33. It opened at $84, $85. Got halted. Then now, as you can see, we're at $122. I don't know about you, but although I like Figma's business from what we've seen, $60 billion when Adobe is worth 150 or 160, generating, I will tell you exactly what the difference is, because someone made a post about that. Makes a bit, well, it makes no sense, basically. It makes no sense. Let me check this here. So Adobe generates $22.6 billion, Figma 821, but growing 40 to 45%. Adobe 9.6%. Market cap 151 billion, Figma now actually more than 44 because
More
the
like
stock
60
just got,
probably, right?
yeah,
What was the
exactly.
original?
The original was 18 billion, but
Oh,
it already
18.
but it opened at way more than 18. It
Yeah.
opened at 44. Yeah, it opened at 44, and now we're like in the 60s. In the 60s, no net income, whereas Adobe is at $6.8 billion in net income. Adobe's price to sales is 6.7 times. Figma is now,
Probably
well,
closer to 60 now.
probably no more, probably closer to 80.
They wowed.
No PE since there are no earnings, but they are growing faster. So yeah, I don't know.
And the thing
Adobe
is, I
will
don't think they're extremely competitive in every. I mean, I haven't read Figma, but it's not like they are true competition.
not at all, not at all. Adobe has one or two competing products that aren't even
Products.
that popular.
Yeah, and that's why they wanted to buy them, because they wanted that
Correct.
segment within it. But it's not like the whole suite is a comparison here. Um,
Yeah,
I
it does seem like people on SoFi and Robinhood got assigned like I've seen plenty of people that only got assigned like one share, maybe two shares or
yeah,
something like that, but at $33. So you are up four
yeah,
x. I
you
don't know
could
if you
sell
can
it
sell.
and get a nice dinner now.
Yeah, I don't know how it works with the selling or not.
Oh, that's true. I don't know if they're,
But
yeah.
yeah, but still pretty cool. Yeah,
Yeah, Robert here says most people only got one share, and then Robert coming in clutch with another one. I think you just clicked it. Yeah, everyone is using Figma instead of Adobe products. 821 million revenue. Yeah,
I
I
mean,
mean, to me, with Adobe, it's a forward PE ratio of 23. You don't even have tech companies in the hardware space trading at those levels anymore, and you're having a software company with margins. It just seems too crazy. The only thing is this market. It's one of those markets where they can continue to hold this negative sentiment, and this is a stock that can trade at lower valuations for a while. Um,
yeah. So this is what I want to say. If you
uh,
sell today, you're getting a penalty basically,
yeah,
which
that's
makes
interesting.
sense. It makes
Yeah.
sense. So yeah,
It would make more sense if you got more than one share, but it's like,
yeah, it's a gimmick. Let's be honest, it's a
yeah,
gimmick at the moment for both companies. But yeah, Adobe, I guess. I mean, Figma being public could help
and
Adobe.
yeah, yeah. And no, I think most of them got them at the 33, right? At the
Yes.
IPO price
Yeah,
itself. Yeah.
yeah. Um, Yeah, because I mean, you have to think about it. These companies don't have that many shares to give, and if like a million people ask for an allocation, then yeah, that's the result that you get. You get one share.
Yeah.
You get one share. But yeah, Adobe being public and Figma being public now, I know that it's not apples to apples, but they do compete in the same design space, and maybe Adobe can get a higher multiple now that Figma is on the market and extremely overvalued. It's not growing at the same rate, but
Mhm.
I mean,
Yeah. Question, I know in the fintech you had that popular Circle IPO. I think it was Circle, or I forget.
yeah,
There,
a
there were
stable
a few.
coin. Yeah, yeah.
Did it drive
Chime.
any sentiment at Chime? Did it drive any sentiments towards other stocks during that IPO process? Um, or
Let's see
was it
what
just
Chime
mainly just
did.
focused on those two players?
Chime actually is not that successful of an IPO, it seems. Because I remember the last time we looked at it, it was also in the 30, like low 30 or something like that. So Chime, no, not much. And in the meantime, you have like SoFi and Dave. I know it's a popular name. Dave has been crushing it recently. So now it seems like Chime did not do so well. But let me see if we actually see some Figma. I doubt
Numbers.
we have anything on here. Too early. Too
They're
early,
early.
but let me just go back to their websites then. Just to show
Yeah.
the results that they posted. So here it is. So last 12 months revenue 821, but it is growing 46%. So you can already like add an, if they do grow, let's say closer to 50%, it's another $400 million for the next year. So that's a $1.2 billion, $1.2 billion in revenue for $60 billion in market cap. I mean, margins are crazy. Net retention rate is super high. 78% of Forbes 2000 use Figma. All of that is great. They do have a lot more growth potential for their own business. But yeah, I mean, I don't know. It's a great company, but I can see the stock going down 50% for sure.
Yeah. Definitely going to be curious. What is? I mean, Adobe is definitely one. I think eventually I want to take a closer look at. But it's actually it's surprisingly pretty big. $152 billion of market cap for Adobe.
Are you surprised?
I'm surprised it's that big. I thought I thought it was at least like 80 billion. I didn't think it was in over the 100 billion.
I mean, it's $22 billion in revenue, growing.
That is true. Yeah, that is true. I mean, that's crazy then. $22 billion in revenue. So like, yeah, that's wild.
PEG ratio of 2, which is not the cheapest, but definitely not the most expensive one. Dividend Dude asking Figma the next Circle. I mean, yes, Circle also had quite a successful IPO. I don't know where they're trading at right now, 180. So did go down a little bit, but well, it was up also in the 60s or something, and then went all the way up to 200 and something.
Were there any? Were you able? Are there any short share? Can you shorts? I don't short, so normally I don't know.
I don't
this,
think you can short IPOs.
You can't short right away, right? If there's some time before. I mean, if there's no even shares to
yeah, there aren't shares available to short. I think.
Yeah. Big Saw saying something here. How long till companies getting ridiculous premiums for growing at 30% revenue when they make less than 1 billion revenue? Not sure.
Especially in a high interest rate environment, which makes this even crazier. Like a zero
weird.
rate
That's
environment.
Weird. Yeah. I understand kind of like when we had those 0.1% interest rates, 1 billion revenue. Like, this company will make it. And then
yeah, I don't know, because something's got to give, right? Because you have companies like Adobe. I did just did the video about Qualcomm, for example, as well.
Did that drop already, Neil?
Yeah, it dropped, I think, an hour or so ago. It is getting too cheap to ignore, especially in a market where things are at all-time highs, where you have companies barely generating any revenue, trading at billions of dollars in valuation. It's, I don't know. I'm asking questions.
For Qualcomm or for Adobe?
For both of them.
Yeah, I think both those companies are I would put in the similar time slot where it's like these are two companies that are successful. It's just the market is waiting, I guess, for the aha moment on them, and giving them that weak valuations. I think Qualcomm has some stuff to prove in terms of getting more products out there, which I think will be pretty exciting. I mean, I do think glasses is definitely going to be crucial for their revenue growth, and eventually Qualcomm is going to be forgotten as a phone business, and it's going to be an IoT business for sure.
Yeah, I mean, look at this. This is Adobe's digital media ARR. Quite nice, no? Compounding at 14% over the last 5 years. It's not bad, right? Not bad. Not bad at all.
Not bad at all.
So yeah, if people are looking at names that are not in the tech space because they want to diversify and they don't want super overvalued names, there are definitely quality companies out there that are trading at attractive prices, depending on what you want to get exposure to. United Health being one. I know Dividend Dude is one in that. Google is still one, believe it or not. And with that, the market has closed. Quite ugly.
I see nice green if I just look at one area.
Yeah, like remove everything and just focus on these two here. Just focus on my Microsoft and Meta and Amazon a little bit at 1.73%. But all the rest, even Salesforce, I would say, even Salesforce is a good value at these prices. It's not a high grower, but
Yeah, I don't know. I'm not a fan of the CEO. I think he has a obsession.
yeah, he doesn't like the Copilot from
Yeah,
Microsoft.
it's unhealthy. It's different from Mark Zuckerberg's obsession with Apple. It's a whole different thing. This one is just a scary obsession. Amazon out already, going up. Let's see what the market.
Let me check Amazon.
Yo, these guys are liars. Up 0.5%.
Liar, liar, pants on fire.
Liars in the chat, but they might be out. Let me check on X.
I'm on their website. No, wrong website. Amazon.com is not the website I needed. It's like I'm going shopping, but nope. No, only maybe here. The thing that I don't like is like most companies, they release their earnings release, but then only 3 hours later do they release their presentation. I'm like, why can't you release the presentation at the same time? This is too much to ask.
Yeah, way too much. Stop asking.
I'm on their website. There's nothing yet.
There's nothing. Yeah, I'm on X, which is usually faster than their website.
Yeah.
Amazon just reported earnings per share $1.68, beating expectations of $1.33. I have it here from Stock Market News on X if you want to pull it up. Revenue of 167, beating expectations of 162 billion. So beat here on revenue, beat on earnings per share. Obviously, the next thing is where's that beat coming from? Is it coming from cloud? Is it coming from ads? Is it coming from all over?
Or is it coming from their investments and recognition of some things? Because I don't know if this is gap or non-gap.
Yeah. So, okay. Now, Zero Hedge has some numbers too. Amazon's second quarter AWS net sales were 30.87 billion, which beat by only $100 million.
Okay, we're good. We have it.
You got it?
Yeah. Oop. Okay.
I wonder, AWS wasn't that big of a beat. I wonder if eventually the street might see that as something negative. I think all the other players beat their cloud numbers by some strong numbers.
Okay, here it is. So, online stores up 11% for a quarter. Then physical stores up 7%. Third-party seller services up 11%. Advertising and acceleration, actually, yeah, I see here. Oh, no, that's just excluding FX, but up 23%. We have subscriptions up 12%. And AWS up 17%. So same growth as last quarter, but tougher comps, I think. Q2 24 is,
but
tougher
everybody's
than
had
Q1.
tougher comps, right, Neil? I mean, it's
correct.
I feel like I don't own Amazon. Definitely good. I mean, you're seeing that 17% growth. You're seeing growth all over. I wonder how picky Street is going to be about that, about AWS. Not seeing kind of maybe our acceleration growth versus some of the other players. But yeah, advertisement business,
they are the biggest.
22%. That is wild.
And that's an acceleration in the advertising business. Excluding FX, you can see this right here. But AWS, I mean, if you annualize this, it's now $120 billion business for them. Let's actually see. Yeah, so North America segment net sales increasing 11%, operating income 49% growth year over year. For the North American segment, international, I assume, growing much faster, but margin here only 4.1%. Operating margin of 3.4% for international and 7% for North America. As for AWS, margins came down actually. Operating margin for AWS previously 37.5, now 36.8 for the trailing 12 months. For the quarter, even lower, 32.9%. compared to 39.5% last quarter. So, interesting. We'll see why that has happened. Although I do see here that Q2 is usually down a little bit. Interesting. Let's see if we've got some comments here from.
Should I check on CNBC, see if we got any comments there?
Yeah, if you have some talking heads talking.
Yeah. Nailed it. Let me see.
Thank you.
What kind of laugh was that, Neil?
Let's see if we've got here some nice comments from Amazon.
How's the stock reacting right now?
I think it was down a little bit when I checked it. Let me see. Amazon after hours down 1.7, not much. So Andy Jassy is saying, our conviction that AI will change every customer experience is starting to play out as we've expanded Alexa Plus to millions of customers. Continue to see our shopping agent used by many millions of customers. I've never used it. Launched AI models like Deep Fleet. They can't be serious with that name. Deep Fleet. That optimized productivity path for our 1 million plus robots. Made it easier for software developers to write code with Cairo, our new agentic IDE, launched Strands to make it easier to build AI agents, and released Bedrock Agent Core to enable agents to be operated securely and scalably. I mean, agents is the topic of the town right now. AI agents is... It's funny because Sundar said it at the start of the year, because agents are going to be the topic of 2025. Operating cash flow for the quarter was up 12%. Again, like I said, for the trailing 12 months, because for some reason they don't want to give us per quarter. Free cash flow decreased to $18.2 billion for the trailing 12 months, compared with $53 billion for the trailing 12 months ending June 30, 2024. So, okay, I guess there is some lumpiness in free cash flow with these types of companies as well. I find it strange that they never, like usually companies, when they give you like operating income is up or operating income is down X amount because this and that happened. And here we're just getting the numbers and that's about it. Like we're not getting, oh, it's down because we experienced XYZ in the quarter. Strange.
Did they give? They talked anything about capex here, Neil? And I'm trying to get on CNBC. I wonder if it's raining like crazy. It's not letting me log in. It's saying server errors.
No, nothing from capex in the press release, which means they'll talk about this during the call. We only got here a guidance. Net sales 174 to 179.5 billion dollars, or to grow 10 to 13%. The guidance anticipates a favorable impact of approximately 130 basis points from FX. Operating income is expected to be between 15.5 to 20.5. That's quite a big range, compared with 17.4 billion in the third quarter. I guess we'll get more information during the call, because the press release doesn't really tell you much as per usual, actually.
Some other earnings, Neil. We did have Reddit.
Apple?
Reddit is up about 10%. Apple.
I don't know. Apple, did they report yet, or?
I haven't seen Apple numbers yet, but Reddit is up 10%. Sales of almost $500 million versus 426 estimated. Earnings per share, big beat of 45 cents versus 19 cents. And quarter three outlook of 540 million versus estimation of 473. So Reddit's coming in clutch with the advertisement space. I'm pretty impressed for it to be up 10% after, I think it was a 10% day today already, right?
Yeah, 7 or something like that.
Something like that. Yeah, pretty wild there.
Reddit. So revenue. Yeah, I mean, not bad. Revenue 500 million, an increase of 78%. Gross margin 90 points. Okay, 19.8% makes sense. GAAP profitable with net income of $89 million and a net margin of 18%. Adjusted EBITDA $167 million, operating cash flow $111. It's a big improvement year over year. Free cash flow, same thing. CapEx, well, we don't care about CapEx for Reddit. We care about CapEx for Amazon. Let's see, daily active uniques average 110.4 million. So that increased 21% year over year, which I think is a bit less or maybe the same as last quarter, but okay. Weekly active uniques, 416.4 million, an increase of 22% year over year. Logged in users grew 17%. I mean, that's their efforts that if you want to read through everything, you have to log in. So the efforts here are working out. Advertising revenue grew 84% year over year. That was driven by year-over-year growth in impressions and pricing. They saw strong growth across brand and performance revenue. As for machine translation, that continues to drive international user growth and available in 23 languages. Anything about Reddit answers? Let's see.
And while you look at that, another one that did report, Coinbase, that one is down about 7% right now.
Interesting. So they're seeing good traction here in their core search product now that has 70 million weekly users, and Reddit Answers has grown to 6 million, up from 1 million last quarter. So big, excellent growth there, quarter over quarter, from 1 million to 6 million. Not bad. Not bad at all. So good quarter from Reddit, for sure. For sure. Why is Coinbase down?
They missed, it seems, on sales. Sales missed by about 100 million, 1.5 versus 1.6 billion. But they also did miss, it seems, on trading volume. Trading volume was 237 billion versus 253. Regardless, though,
the heck is this EPS beat?
Yeah, I guess there was a one-time something. It has to be.
Okay, let me pull this up. Guess this makes more sense to look at. So 1.5 billion.
Up on Reddit. Yes, Reddit had a good one. Even though I don't own and I don't know the valuation, but just the business itself looks pretty good from what the numbers they showed.
Yeah, no, they have momentum. That's for sure. I mean, the business definitely has momentum. Amazon still, the earnings. Yeah, the call is we still have time until the call. In the meantime, maybe Apple forgot that they have to report today.
Their AI told them tomorrow, so
they're like,
because their AI is bad. So
yes, we got the joke. We got the joke. But if you want to explain it further, you can.
No, that's it. I think that's all we need.
Yeah, Amazon pretty good, but I guess the market wants more information about AWS CapEx during the call, because currently it's down 2.1%. It's not big of a deal.
Yeah, and I was looking at the prices. I mean, these prices that we saw before the pump from yesterday. I think Wednesday was at $228, and that's, I think, what the stock is at right now. It's just giving back some of the gains it had today on maybe some more expectation. I think, again, I don't think it was a bad quarter, but it was just that the sentiment, I think, from at least the other cloud service providers, it was a nice beat on the cloud business, and some commentary of why that didn't happen here. Did they have maybe a delays in some of the servers they were hoping to build up? If so, then not a bad thing. If they go out and say, you know what, our servers actually came out a week after than we expected, and that kind of hurt AWS, but next quarter we're going to see some nice growth there. I think that that could shake off any fears of maybe AWS losing some market in this space.
Yeah, because they are the biggest. So I guess when you're the biggest, maybe you move a little bit slower. But based on their own comments, they have more demand than supply. So I'd love to hear a little bit more a little bit more information. With regards to Coinbase, what was the big miss? Did you say trading volumes?
Yeah, they said something about trading volumes. Yeah.
Let's do something like this. Let's see if it understands,
Yeah.
or if it finds a. I mean, I could probably say that maybe it's because people are using Robinhood.
Bullish Robinhood.
Yeah, maybe. So key factors here, and by the way, all of this is already available on fiscal.ai. We barely finished, I mean, closed the market, earnings reports coming out. All of this is already available on fiscal.ai. Link is down in the description. So they say here, one of the reasons crypto spot volumes were down 31% globally and 32% in the United States, coinciding with a relatively flat average crypto market, capitalization, market cap, and a 16% quarter-over-quarter decrease in crypto asset volatility. Stablecoin strategy shift. I don't know what that has to do with it. An intentional pricing change in March aimed at evolving the stablecoin strategy, disproportionately affecting the stablecoin pair trading volume. Okay. Consumer trading volume decline. So that was also down 45% quarter over quarter. And institutional trading volume declined as well. That was $194 billion, also down 38% quarter over quarter. So influenced by a combination of reduced market volatility, a strategic shift in stablecoin pricing, and a shift in consumer trading behavior towards simpler platforms, aka Robinhood.
I mean, I don't know.
I mean, it's not like this one hasn't been performing well, right? This
Yeah,
thing is
it's
up
demolishing, right? It's up like X. It's a
over the last
multi-bagger in a few years, right?
3 years, 450%.
Very
So,
nice, very nice.
um,
To be honest, I
and
thought there would have been more trading volume on crypto. I don't know. I felt like every other week we were hitting like new highs on something. I don't follow the crypto market, but on X, I felt like Bitcoin every other day was hitting a new high or a new low or something or something.
yeah, but maybe
So I saw
just
that volatility.
not on their platform.
Yeah.
Could be on Binance, could be on Robinhood, because I wonder Robinhood what they did for crypto volumes, crypto trading, maybe. Trading volumes did increase. No, sorry. Robinhood crypto notional volumes did decrease also 39% quarter over quarter.
And they
But
reported yesterday, right? You would have expected, but Coinbase was also down for the day. So they kind of, I guess, pre-expected some drop there, but maybe it was a lot heavier than even that.
yeah, and you can see this here, transaction-based revenue down for the second quarter in a row, and you can see crypto had a huge increase. I think when Trump became president, that quarter was insane. Since then, it has come down. But options, I mean, some of you guys on Robinhood, you're a bunch of gamblers there. I mean, the options is increasing quite fast on Robinhood. Equity barely anything. So it's crypto and options for a transaction-based revenue for Robinhood, and then net interest revenue is basically the other big chunk there for that company.
Amazon stock is still down about 4%, about 3.8%. Again, there's some people coming in. Like I mentioned, I don't think there was anything crazy with Amazon. It was just more of the what I think is just maybe the AWS didn't meet the expectations that maybe the whisper numbers or something we're expecting there. But like you mentioned, it's the biggest player there, so you don't expect that type of growth as some of the other players. But I wonder. I think it has to do some with AWS. We're gonna have to see the questions. Obviously, the questions during the Q&A session can kind of give us the understanding of where what the market is looking the answers to.
Yeah, currently down 4%. Currently down 4%. And yeah, Robinhood, I mean, ton of prediction market contract traded, which is basically gambling. I mean, I said it before, Robinhood is just a financial casino at this point, which You can like it or not. They're making quite a lot of money, but it's basically that. It's basically that.
We have someone here having a huge feeling Apple will crash. Has Apple still numbers are still I don't know. Joseph here is maybe a little bit too much. I hope Apple drops 50%.
I wonder if they dare say something about Siri during the call.
SMH.
Yeah,
for the
Amazon
day,
is dropping back under that 20-day moving average. I mean, let's see how low can this go. How low can this one go? So that's Amazon. Reddit is doing very well, continuing its way up. Nice recovery here for Reddit. Coinbase. Let's see what happens with them. Okay, maybe we'll see 335 or so. I actually could find some resistance at the previous stop, but yeah, that's just black magic technical stuff. But yeah, for those that are just coming in right now, Amazon, these are you just have to go to this slide right here, slide 12, and you get to see all of the business segments and the growth rates for the company. Still good, but the market was probably expecting a little bit more, or just waiting to get more information from management. So why is SMH down, Jose?
SMH, I don't know. I think that just the semiconductor market was down today. We saw a heavy decrease in equipment players after Lam Research, and you kind of got that memory downturn from Micron. I was trying to see if there was anything after hours, but no, it was just throughout the day. So I think just most semis were down today.
Okay. Fair enough. Anything on the CNBC or?
I couldn't log in. They're having issues. It's not me. It's them. It's not me. It's them.
Yeah. I listen to you in No Earnings Day Gamble. Thank you. You say buy on Amazon. I mean, sometimes it's just not worth it. So what is this? Sarepta. Never heard of this. Medical research and drug development. No, that's not for me. I feel like every stock that has a name and then ends with therapeutics is down 80 to 90%.
I do have CNBC working. I don't know where you want to start off. Do we want to start off with Amazon first, Neil?
No, of course.
Okay, relax. Let me share your screen and you let me know.
Hey, so those shares are down 2.5%, and it might have something to do with Q3 operating income, what they're guiding to for Q3. They're saying it's going to be in the range of $15.5 billion to $20.5 billion. That puts the midpoint at $18 billion. The street wanted to see $19.48 billion. Other than that, we've got a Q3 revenue guide of $174 to $179.5 billion versus the analyst consensus of $173.1 billion. So that's a beat there. I want to also shift over to the other side of their business, which is the retail side. That's showing strength. We saw 3 key beats. So online sales, that came in at $61.48 billion against the street's $58.98 billion estimate. Third-party seller revenue. This is the metric that really offers insight into how outside businesses are performing on the platform. That's a beat, $40.34 billion versus $38.7 billion. One more number I want to bring you guys is North America revenue. Another beat here, $100.06 billion versus the consensus of $97.65 billion. We care about this number because we're talking about net sales from its core U.S. and Canada operations. This really is an indicator of the health of the domestic retail market. Listening to the call to see what color they can give us on CapEx. That is the big number that we are waiting for, guys. We're going to see if they revise up from that $100 billion number that they gave us in Q1.
All right. Yeah, Mackenzie Sigalos, thank you. Let's continue to take a closer look at Amazon's report with Rohit Kulkarni from Roth NKM. Rohit, good to see you. So AWS growth, 17.5%. We got some extra detail from Microsoft on Azure's overall growth. How does AWS's growth and the operating income at 10.2 billion look to you in terms of share and competitiveness with the others?
So AWS has been the leader, as you know. They've been, as the prior speaker said, they've been caught a bit flat-footed on how to take advantage of the AI cloud, AI compute, and AI inferencing theme. I believe they are playing catch-up, and the slight acceleration of a very large base is encouraging, in my opinion. The acceleration from over the last couple quarters that we are seeing, and we see that to be sustainable. And this is a company that generates, AWS generates more than 30% of margins. So market leader, accelerating revenues with market-leading margins. I think that's an encouraging sign. And for the first time, we saw AWS coming in slightly above expectations. So perhaps the AI cloud layer is starting to show up in the numbers, and that's what we would like to see on the call.
Okay, tell me your sense of where we are for investors who are looking, trying to see who's getting a better business built in AI in the cloud. My sense is the product's still being built. They're trying to, the different hyperscalers design chips that allow them to more efficiently get these jobs done that customers are demanding. Are we yet able to see how that's panning out, or are they still making adjustments as they form these relationships with the various model makers and build the products?
I think we are still in learning and building mode, almost comparable to where we were with 2012 when it came to internet cloud. So we are still very early as far as which products, which tech stack, which category of completely vertical tech stacks and in-house silicon versus Nvidia GPUs, all the various combinations of pricing and product and offerings, they're just coming together. And the big three, which is Amazon, Google, and Microsoft, are rushing to put out products to help AI labs be their exclusive partners. So I think by sometime early to mid next year is when we'll actually see probably more compute, more demand for these data centers being built as capacity constraints start to perhaps reduce over the next 6-9 months. And that's where the CapEx comes in. It is a 32 billion CapEx quarter, which is a $120 billion run rate, which is a massive, massive number. That gives us confidence of revenue in the future.
Yeah, so Rohit, when I think about Amazon, I think about a company that over the years has at times sacrificed profitability to reinvest into itself and disrupt itself and disrupt and reach out into new markets too. So when you do look at this CapEx number that for the quarter came in so much higher than street expectations, and you do look at some of the details around free cash flow and margins in the guidance, is this just another iteration of that for Amazon?
In my opinion, I think this new era of Amazon that we are in is where they're balancing profitable growth, unlike where Meta has entered right now. Meta almost feels like it has entered into that era which was comparable to what Amazon was in when people cheered when they missed earnings. Today's Amazon's era is almost where they are generating sufficient amount of cash. It is the stock can be bought on earnings, and hence we would be very surprised if next year's earnings or some of the profitability metrics come in below expectation and they shift gears into investments at all costs. I think the company has enough levers right now as compared to 10 years back that they can balance profitability in a certain pile of business and invest in another pile.
Okay. Rohit Kulkarni, thank you. With Amazon still sinking, now down a little bit more than 4% in over time. Well, lots of earnings reports.
Did you manage to catch the CapEx number that he said?
He said 32.
32 for the quarter.
Yeah, so 120 plus if you on a run rate.
Yeah, because I think the previous number they gave us was 100 for the year. So maybe accelerating, which means they're trying to meet demand.
Yeah, I mean, yeah, it seems like we talked about it a little bit, that there might be some reports that they were a little bit lacking in AI server movement. And maybe that's just catching it right now. But the great thing is they could just build those servers. And maybe that's what they're trying to do with that CapEx. And I think we're going to hear a little bit more during the earnings call. But if they if AWS is the issue, it's an issue that can easily be fixed, in my opinion.
Yeah, and there was that announcement that we covered last couple of weeks ago, right, when they announced their new rack system that should make them more efficient, that should make them more faster. Maybe that could help the deployment and maybe the margin profile even more, even though margins are still above 30%.
And, now that I think about it, Neil, I wonder if that was a reason why they maybe were slowing down with it. They wanted to, I guess, perfect how they can move on with the data center. No point in building new of moving on if you didn't have the right plan. So I wonder again. Hopefully, all that Apple is out. Maybe we can look at that, and maybe I'll look really quick at
before we go into Apple. Salesforce is buying another company. Apparently, they signed a definitive agreement to acquire Bluebirds. Yes, a leading AI-powered prospecting platform that helps sales teams identify and engage high-potential leads using advanced lead intelligence and data enrichment. It's probably not going to be as big as the Informatica type of acquisition, but it's yet another acquisition for Salesforce, expected to close in third quarter of Salesforce fiscal 2026, which I think they are ready right now in their fiscal 26 year. Let's see if they are. Yes, they are in their fiscal 26 year. Okay, so that's Salesforce. You say that Apple is out.
Yeah, I can share screen really quick, Neil, if you want. I mean, they're already talking about it.
Yeah, you can, of course.
And then while you can maybe look at the numbers really quick.
Beat at $1.57. Street wanted to see $1.43. Revenue also a beat here. Really strong revenue quarter, $94.04 billion. Street wanted to see $89.53 billion. That, by the way, 10% year-over-year growth and the best quarterly year-over-year growth we've seen at Apple since the December 2021 quarter. iPhone also a beat. You were just talking about seeing growth there. That is up 13% to $44.58 billion for iPhone revenue. Street wanted to see $40.22 billion. Services also continuing that growth streak, $27.42 billion compared to the $26.8 billion expected. And China is back to growth, John. It's up 4% for the quarter to $15.37 billion. We see shares here reacting to this up about 2%. I'll send it back over to you.
All right, thank you. Patrick Moorhead, let me get back to you on this. Look, I'm sure we'll have plenty to talk to you about as well. This kind of goes against the narrative, China being back to growth because AI is not built into iPhone Siri yet. There's all of this doom and gloom around the stock. It would popped a little bit initially, but it's modestly higher. What's your reaction to these numbers?
I'm very impressed. I didn't expect this. You are seeing, I mean, they have the killer brand in China. That's probably the biggest growth surprise that I'm seeing. I do think the temperament between the US and China cooled off, and then it got really hot, and then it cooled off again. And we're at a period where the nationalistic China buy is still there, but not nearly to the extent that it was in the prior quarter. And I think, for me, it was puts and takes, right? You have the September launch coming up when typically the West pulls back. But then again, you had the fear of tariffs that people were talking about on social media that accelerated that. And it appears that the let's buy quickly based on potential tariffs and price increases overpowered everything else for the iPhone outside of China.
Interesting. Gil, do you see it the same way, especially given the beats across the board?
Yeah, that's right. There's a lot of noise because of what Patrick just pointed to, which is there could have been some pull-in of demand. Let's not forget in China, we had a couple of quarters that were relatively weaker with inventory clearing. So that set us up well for this quarter. And between those two things, that could explain some of the surprise. But I would say it may not be a coincidence that this is the best stock react or the best iPhone results since end of 2021, because that's when we upgraded to iPhone 12, which was the last big upgrade. this iPhone may not be a huge leap forward, but it is the biggest upgrade since then. So maybe we are getting a little bit of the upgrade cycle beyond the noise. And by the way, the noise in China will continue because it is right in the crosshairs of the trade dispute between the US and China, and it will continue to be there probably going forward.
Okay. Shares of Apple are up about 1.5% right now. Let's get back to Steve Kovac for more on these results from Apple.
Yeah, Morgan, I did catch up with CEO Tim Cook on these results, and we did talk about what Gil and Patrick were just talking about a little bit. On China, we did talk about the subsidies from the government being a boost for the iPhone business there, so that perhaps definitely weighed into the results on top of the JD.com shopping holiday, kind of their version of Amazon Prime Day. But let's talk about tariff impact and the idea of the pull forward demand. Tim Cook telling me that actually did happen a little bit. Here's what he said, quote, on the buying ahead relative to worrying about prices on tariffs, we did see some evidence of that in the early part of the quarter. We would estimate it to be about 1 point of the 10 points of company growth. So that top line revenue growth, 1 point of that, Tim Cook attributing to this idea that people were buying forward ahead of those tariff impacts. Also caught up with him about artificial intelligence and the investment we've been seeing from so many of Apple's peers. Just yesterday, Microsoft saying they're going to dump $30 billion into CapEx for AI. He said, Tim Cook telling me, investment's going to be growing. We're significantly increasing. I'm not giving you an exact number today about what that means, but we significantly increased in the June quarter, and we're significantly increasing in the September quarter. He also told me that is both for artificial intelligence talent and, of course, the compute side of things where all the money is really going. And then on M&A, there's a lot of questions about whether Apple needs to sort of acquire itself into this AI moment. Tim Cook telling us that he acquired 7 companies so far this year, not all necessarily artificial intelligence, and also saying none of those have been huge in terms of dollar amount, but we're open to M&A that accelerates our roadmap, and so we're not closing anything off there. And by the way, guys, the call is going to kick off here in about 25 minutes. Cook telling me we'll get some more detail and color, not just on forward guidance, but also the overall tariff impact and how they plan to mitigate that. So more to come here on the call, guys.
Okay, so we were wrong. Apparently, people are still buying iPhones. So these are these are the numbers. So yeah, like we've heard, a beat on sales, beat on EPS, beat on China sales, and beat on iPhone sales as well. So overall, this is what we get for the quarter. Product revenue, $66.6 billion. Services, $27.4 billion. Net income did increase to $23.4 billion. EPS, $1.57. And then here, net sales per segment. America still the largest. That has increased nicely. Europe has increased. Greater China increasing as well. That was the big question around that. So a small beat, but a beat nonetheless in China, in Japan as well, growing there. And then iPhones. iPhone coming in at $44.58 billion, up from the $39.29 billion same quarter last year. Mac has increased by $1 billion. iPad decreased. I don't think they came out with a new iPad. Maybe they will come out with a new one. So, okay. Wearables decreased as well, but that has been coming down for quite a while. And then services keeps on increasing. So that's good. Now, did you hear during one of the guys talking about subsidies in China? Mm-hmm. The first time I heard about this, I was like, wait a second, you get subsidies to buy phones? Well, yes. Couch Investor tweeted about this May 22nd. I didn't know that phones in China get a state-subsidized discount. Quite interesting, huh? But then again, when they want to spy on you, of course, they want you to have a phone in your pocket. So it makes sense. But I didn't say this. I didn't say this. Xi Jinping, I didn't say. I didn't say this. It's a hypothetical. It's a hypothetical.
The AI said it.
I didn't say anything. So yeah, I mean, I guess Apple did lower the price because previously they were not eligible for it. So I guess they did maybe lower the price to get that subsidy from from the government.
George, we got 11 Apple devices in our home, and that excludes AirTags. Of course, it's sticky.
Yes, it is. I mean, that's the thing. I mean, we both admit that Apple's business and the ecosystem is one of the best ever created. But I mean, how many new iPhones do you need?
Yeah. So definitely surprised by the B. I didn't expect there'd be a growth. Not just Apple, but just in the phone business. I didn't see that there was much of a. I didn't think there was going to be a growth in the phone business for regardless of who it was.
Yeah.
And it was interesting to hear that maybe we might hear some discussions on
AI.
Investments. Investments in AI, at least for that portion. And maybe the market might actually like that a lot.
Or not, depending on what they actually say. Because they did say that they acquired 7 companies already this year. It's quite crazy that they can acquire companies and that goes under the radar, which tells me, 1, those aren't interesting companies, and 2, Apple can acquire companies, but Meta couldn't acquire a GIF making company. Remember that story from a couple of years ago? They wanted to acquire that company, Giphy or whatever, the GIF making company, blocked because anti-competitive or whatever that means. Makes no sense. Makes no sense. They do say here that innovation, the introduction of new software designs and Apple Intelligent features at the Worldwide Developer Conference is highlighted as a key factor in driving customer engagements and sales. I don't know about you, but people were making memes about what Apple released not so long ago. What was it? Liquid glass or what was it called?
I don't know what still.
But someone told us that you can now move icons on
Thanks
the
to
home.
the home page. That's wild.
So that's
innovation.
I mean, that is truly innovative. But let's see what they say about Siri, about their AI investments, hiring as well. That's the thing with Apple. It's still a good business, and it seems like
it's something we don't knock it for. We know it's a good business. Exactly. It definitely has.
But this
innovative. Yes, this is true. It's a joke. But it's money, and they got it. Yes, that is true.
Yeah, that's a luxury position, a very good and luxury position to be in. Money-making machines.
I wouldn't know anything about that. Oh, my stocks just burned.
Amazon still down 4%. Coinbase is still down 3%, but apparently it's
Figma still up 7% after hours after some bullish sentiment that came from some of these earnings.
Reddit up 20% now.
I wonder if there was any interesting semiconductors reporting after hours today.
Let me check my advanced money doubler.
Reddit. Flat. Did you say Reddit already?
Reddit 20%.
Yeah, that's wild.
Reddit wild. 20%. Nvidia
after 8% day.
Also downish. Why is Amazon down? Still waiting for more information on AWS growth, CapEx, and all of that.
Mm-hmm.
The quarter was fine.
If I was an Amazon shareholder, it wouldn't have been anything that would be like, I hate this. But it's just like, what are you doing now with AWS and CapEx?
Yeah. Like, can you accelerate it? So apparently Coinbase is recovering on announcement of tokenized stocks and prediction markets. So the Robinhood playbook, basically. The Robinhood playbook. And if it works for Robinhood, you could say it's going to work for Coinbase, depending on the fees, I guess. But yeah, someone said, like, who's trading on Robinhood? I think if you're a subscriber of who's trading on Coinbase, I think if you are a subscriber of Coinbase, I think the fees are removed or extremely, extremely low. But yeah, I wouldn't be buying on Coinbase because the fees are very, very high. Very, very high. I think Roku also reported the long lost.
Roku. Yeah. Cloudflare. It used to be a popular one during the COVID time. Net ticker net. is up, I think, about 7%, 6% right now.
5.
This one did pretty 5.9. That's 6 to me.
Yeah.
Up 84% year to date. This one's been doing pretty nice.
Yeah, it's not a cheap name, but apparently it's been doing quite well. Revenue increasing 28%. Still losing money. Loss from operations still. Delivered current RPO year-over-year growth of 33% and RPO year-over-year growth of 39%. That's not bad. That's not bad at all, actually. Let's see.
Yeah, and for Semiconductor, the MPWR, this one,
monolithic
power, they were up about 4%. I saw, but I said I need cool names.
I mean, monolithic power is a cool name.
It is. That is true.
It's like one of those stones that maybe some Marvel villain needs.
But this has been pretty interesting. Power Solutions, and for a long time they've been talking about kind of, they provide a lot of solutions for like GPU for the motherboards and servers, and with the GPUs growing, it's I wonder if that continues to be one of their tailwinds there.
How much of Reddit pump is Wall Street bets?
That's interesting. Now that it's pumping, people are gonna go to Reddit to talk about it some more, and then the cycle of growth just continues. I think Reddit and found out the ultimate infinite money loop.
So it's a good loop. It's a good loop. Let me go back to Amazon and see. We still have 13 minutes until the call starts. So in the meantime, let's see if I can find something. Something that came out. Let's see.
Oh man.
Could Amazon hit at least 240? Could, yeah, for sure.
Yeah, it's possible. I mean, I think even Martin mentioned Amazon. He believes Amazon will recover by Monday. I mean, depending on the call, it could actually recover by after earnings call.
Exactly.
I think call could move a lot.
On the downside as well, don't forget.
Yeah.
But I mean, this is also a stock that has been moving very, very rapidly. I mean, since the lows in April, this thing, what the heck happened here?
What are you doing there, Neil?
I don't know. Voila, poof. This thing was up 45%, and now it's up 40% with the after-hour action. I mean, it's a company worth what, $2 trillion or something like that. 2.5 now, maybe 2.4. So it's been making moves. It's also a company that historically likes to just reinvest everything they have into the business for future growth. And so maybe the market again is like right now, okay, fine, but all the rest are showing already some good signs. You're still growing, but why aren't you growing maybe faster? But those are the questions and the things that we will get answered, obviously, hopefully during the earnings call. As for Apple, yeah, they're back to prices not seen since basically last week. So
Apple, really?
Yeah, last week they were at 214, then they dropped under the moving averages here, and now we're back just above the 200 day one. But yeah, other than that, that's about it for now. 10 minutes until the call, and this time I will not put the music on, so we don't have to get screwed over by the monetization gods. On
what happened with Roku? That I know you talked about it, Neil. Did they not?
I don't know. I checked and there was nothing.
Up and then it was flat. Yeah.
Yeah. Let's see if I can find it on their website.
Roku drives up Q2 revenue 15%, turns in surprise profit in solid earnings beat.
And that's why the stock is flat.
Billion. Yeah. It was up for a while and then flat. This is another one that got forgotten about.
Yeah. But
that's wild. It's still down over 80% from that COVID high.
According to Cathy Wood, it's a $1,500 stock, I think, next year.
Nice.
If I remember correctly.
You don't care about the 4 years. It's all in that last year. We're getting to that 15.
So this is Roku. Net revenue $1.111 billion, up 15%. Platform revenue up 18%. Gross profit up 17%. Streaming hours were 35.4 billion, up 5.2 billion hours year over year. Roku Channel remained the number 2 app on their platform in the US by engagement. They used to show me the streaming hours quarter over quarter, but that's not shown here.
Not there anymore?
Right? No, I don't.
Bearish.
I don't see that. Free cash flow trailing 12 months. Again, with the free cash flows trailing 12 months, I hate it when companies do that. But okay. I don't know why there's no pictures here, but fine. Seems they also announced this repurchase program.
Nice.
400 million.
Not earnings related, but damn it, what was it? Wondering, any news on Tesla today? Stock was down, but I did see made that big news of robotaxi in San Francisco. I'm surprised I didn't hear a little bit more about that. Neil, any thoughts here?
Yeah, I don't know. I guess. I mean, remember they launched in Austin, and since then it seems like that has been forgotten as well. Which, again, Elon is maybe to blame. Yeah, might be good, but Elon might also have taken the shine of that announcement with his tweets right after that, when he started talking about the American Party. But yeah, since then, I don't know. We haven't heard anything. I know there were some pricing changes. They went from $420 to now $6.99. Maybe that has changed or not. I don't know. But again, I don't think there are that many vehicles going around. Right now, plus the earnings report. The earnings report was just let's be honest, was just not good.
Earnings call hasn't happened yet. It's still 5:00 in about 8 minutes. We also had this question, Neil. Can anyone tell what ASML is selling off last month? Someone mentioned something, Florian. This was one of the things they couldn't really guarantee much growth in 2026, and there was some negative sentiments there. You also kind of have maybe recent negative sentiments of Intel slowing capital expenditure, right? Neil, they kind of slowed down their they're stopping their plant in
Europe,
2 plants in Europe, right? Germany
and Poland, I think,
and Poland, and then they're slowing down the build outs of some stuff in Ohio, I believe. So all that can be seen as a negative headwind for some of the growth rates for ASML. Now the question is here, right, Neil, is this new news for ASML, or is this news that was already baked into that guidance? Because if it is new news, then that definitely could put even more pressure onto the stock. I would be hopeful to think it's not. I would be hopeful that a lot of these companies, ASML would have already known beforehand if maybe some of the orders were going to come in or not. So I'm more hopeful on that, but it's just a lot of headwinds are impacting ASML, in my opinion, in the short term. In the long term, you did kind of have something with that EU and US trade agreement. But we still haven't seen, because the US is still doing whatever, I think it's that 252, I forget the actual number, of like that special research on the market. We still haven't seen what they're going to do with the semiconductor space. That's still under investigation, which I think should be ending soon. So yeah, what else?
Correct.
Yes, correct.
Correct. I don't know who's following this, but I've seen one comment on First Solar reported. Solar and energy players have been hit quite a lot, but First Solar is not like an Enphase. They're actually up now 4.7%. They'll be around, I think they'll be flat for the year after this. And it's a good quarter. They even said here, In our view, the recent policy and trade developments have, on balance, strengthened First Solar's relative position in the solar manufacturing industry. In addition, we believe that a fundamental basis with a cost-competitive energy and faster time to power profile, the case for utility-scale solar generation is compelling regardless of the policy environment, which places First Solar, a utility-scale leader, in a position of strength. So unlike companies like, I'd say, maybe Enphase, for example, who are very much under pressure with the new policies, and especially with the fact that interest rates are still high and subsidies will be lowered and probably removed over the next couple of years. Might or might not happen, of course. But yeah, First Solar, pretty good company if you want to get exposure to that energy segment. Don't have to. You can just.
I don't want to. Thanks, though.
No, that's fine. Something. Let's see. 4 minutes until the call.
Yeah. Let's see what we have. So Amazon, what's going on with Amazon right now? Still down. Some people are saying it's recovering a little bit. Martin says it's only down about 2%.
Yeah, recovering a little bit, but not much. Not much. The market just waiting for the earnings call.
Someone, is the Apple ER call guaranteed to make the price go higher? Nothing's ever guaranteed in the stock market, except that there's no guarantees. I think that's the only guarantee.
And that's fading already. It's now only up 1.4%.
Yeah. And we're getting a little bit of talks here on the ASML. I would just say for ASML, I think there's still a long-term potential. I mean, you're still seeing kind of a huge tailwinds. What happens when the AI market enters the consumer product, the amount of chips that are going to be needed there, you're going to need the increase of you're going to need more supply chain lines. So there's a lot of different tailwinds behind ASML. I think it's just in the short term, there could be some headwinds that the market is not going to like.
Correct. What is this name? There was a name that someone put in the chat before, but I forgot. Clear water? No, I don't know. Forget about it.
Forget about it.
When the earnings call is in 2 minutes. Usually earnings calls are like an hour or an hour and a half after the market close. For everyone.
Rise of the Phoenix. I don't have any thoughts on D-Loco. I think that's the D-Loco, right? I don't follow that market. Right, so nothing. But if Neil says it, I'm going to give him at least some little bit of trust.
Thank you. I appreciate that.
Clack in red. Black stock. It does seem like a lot of semiconductor equipment stocks were down today. Lam Research reported last night. I'm going to do a little research on this, but I think semiconductor equipment stocks are getting, at least some of them are getting unfairly beat in the short term of things. So
Qualcomm being down 8% is ridiculous. Like you would think this would be a super expensive stock, but it is not. We already have here some slides available on the earnings call, so we can have a look at that for Amazon. So net sales North America 60%, then international 22%, and AWS is 18% of the total revenue. And this is net sales trailing 12 months, about the same split here, about the same. Operating income up 31% year over year, or 30% on FX neutral basis. Trailing 12 months up 40% to $76.19 billion. As for net income, up 35%, and then trailing 12 months up 59%. So a bit of a small slowdown right now. Net sales and operating income from North America Operating income is more interesting here. So we're up 48% year over year on that. As for international, up 448% because, well, it was very, very small previously, but it's good to see that the international side of things is getting a bit more profitable. And then AWS here up 9% year over year. So yeah, I'm interested to hear why it is a bit lower for the quarter. Operating margin. I know last quarter was amazing, 39% or so. No, music. Nice try. Nice try. But no, it's music. Free cash flow trailing 12 months is down 66%. Long-term goal is to optimize free cash flows. That's probably why they're giving us trailing 12 months and not the quarter to quarter. And then eventually, I do want them to start buying back a boatload of shares because Amazon is one of the only big tech companies out there, I think with Tesla, where there's no share buyback. There's no share buyback, and share outstandings have just continued to go up time and time again. So,
and while we wait for earnings call, we have Waldo. What do you guys think about TSMC? Someone says the intrinsic value is 154 and it's overvalued. I don't agree, but would like your thoughts. I don't agree either, Waldo. I think there's growth opportunities there, but I'm just not an investor. All right, earnings call, go.
Welcome to our Q2 2025 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have a press release in front of you, which includes our financial results, as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2024. Our comments and responses to your questions reflect management's views as of today, July 31st, 2025 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions, tariff and trade policies, and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $167.7 billion in revenue, up 12% year over year, excluding the impact from foreign exchange rates. Operating income was $19.2 billion, up 31% year over year, and trailing 12-month free cash flow was $18.2 billion. We saw good progress across our various customer experiences and businesses this past quarter. Starting with stores, we feel good about both the inputs and outputs of the business. At Amazon, we think of our business in terms of inputs and outputs. Outputs are metrics like revenue or operating margin, but of course, you can't manage at the output level. It's the inputs that drive the outputs. So we spend virtually all of our time internally talking about and goaling against inputs. The inputs that matter most to customers in our stores business are selection, low prices, and speed of delivery. We've taken another step forward in selection these past few months, headlined by the much-requested return of Nike's products to Amazon's retail store. We've added premium brands like Away, Aveda, Marc Jacobs fragrances, and brands from Saks and Amazon like Dolce & Gabbana, Etro, Stella McCartney, Rosetta Getty, and La Prairie. And we started expanding our very successful perishables pilot, where we offer customers perishables at the point of purchase when they're ordering other items that will be delivered same day from our same-day fulfillment nodes. We're seeing strong customer adoption, as 75% of customers who've used the service this year are first-time shoppers for perishables on Amazon, with 20% of customers who use the service returning multiple times within their first month. Our prices continue to be low and sharp for customers. It's one of the reasons our everyday essentials growth outpaced the rest of the business globally and represented 1 out of every 3 units sold. It's also why well-known research firm Profiterome has concluded for 8 years in a row that Amazon has the lowest prices of any U.S. retailer. But perhaps the clearest outputs are the rate at which our stores business grew this past quarter and the success we saw in our recent Prime Day event. This year's Prime Day was our biggest ever, with record sales, number of items sold, and number of Prime signups in the 3 weeks leading up to the Prime Day. Customers saved billions of dollars, and independent sellers, most of which are small and medium-sized businesses, saw their best sales performance of any Prime Day event yet. There continues to be a lot of noise about the impact that tariffs will have on retail prices and consumption. Much of it thus far has been wrong and misreported. As we said before, it's impossible to know what will happen. Where will tariffs finally settle, especially China? What happens when we deplete the inventory we forward bought or that our selling partners forward deployed in advance of the tariffs going into effect? If costs end up being higher, who will absorb them? But what we can share is what we've seen thus far, which is that through the first half of the year, we haven't yet seen diminishing demand nor prices meaningfully appreciating. We also have such diversity of sellers in our marketplace, over 2 million sellers in total, with differing strategies of whether to pass on higher costs to consumers, that customers are advantaged shopping at Amazon because they're more likely to find lower prices on the items they care about. Further improving delivery speed remains a key focus, and we continue to make progress. We've previously shared how we re-architected our U.S. inbound network into a regional structure, allowing us to place inventory and ship from locations closer to customers, improving speed and lowering costs. That work is delivering tangible results. In Q2, we've increased the share of orders moving through direct lanes where packages go straight from fulfillment to delivery without extra stops by over 40% year over year. We've also reduced the average distance packages traveled by 12% and lowered handling touches per unit by nearly 15%. We've made progress on order consolidation. With more products positioned locally, we're able to pack more items into each box and send fewer packages per order. That has helped drive higher units per box and improved overall cost to serve. Taken together, these improvements are making the network faster and structurally more efficient. We've also set another global speed record in Q2, delivering to Prime members at our fastest speeds ever. In the U.S., we delivered 30% more items same day or next day than during the same period last year. Items customers used to pick up locally in nearby physical stores are now arriving at their door, often within hours. And we're working to further improve delivery speeds no matter where customers live. We've recently announced plans to expand our same-day and next-day delivery to tens of millions of U.S. customers in more than 4,000 smaller cities, towns, and rural communities by the end of the year. Today, it's already available in more than 1,000 of these communities across the U.S. The early response from customers in these areas has been very positive. They're shopping more frequently and purchasing household essentials at meaningfully higher rates. Automation and robotics are also important contributors to improving cost efficiencies and driving better customer experiences over time. We deployed our 1 millionth robot across our global fulfillment network and unveiled innovations at our Last Mile Innovation Center, such as automated package sorting and a transformative technology that brings packages directly to employees at an ergonomic height. We rolled out Deep Fleet, our AI improves robot travel efficiency by 10%. At our scale, that's a big deal. Deep Fleet acts like a traffic management system to coordinate robots' movements to find optimal paths and reduce bottlenecks. For customers, it means faster delivery times and lower costs. For our team members, our robots handle more of the physically demanding tasks, making our operations network even safer. This combination of robotics and generative AI is just getting started. And while we've made significant progress, it's still early with respect to what we'll roll out in the next few years. Moving on to Amazon Ads, we're pleased with the strong growth, generating $15.7 billion of revenue in the quarter, growing 22% year over year. We continue to see strength across our broad portfolio of full funnel advertising offerings that in the US alone help advertisers reach an average ad-supported audience of more than 300 million across our own properties. These are properties like our retail marketplace, Prime Video, Twitch, and Fire TV, in live sports such as NFL, NASCAR, and the NBA, as well as third-party websites and apps. Another area we're excited about is our demand-side platform, or Amazon DSP. Our DSP enables advertisers to plan, activate, and measure full-funnel investments. Our trillions of proprietary browsing, shopping, and streaming signals paired with extensive supply-side relationships and our secure clean rooms provide advertisers the ability to optimize advertising, deliver greater precision, and drive efficient and effective advertising outcomes. And in June, we announced a momentous partnership with Roku, giving advertisers access to 80 million connected TV households, the largest authenticated connected TV footprint in the US, exclusively through Amazon DSP. It's a giant leap forward for advertisers, bringing best-in-class planning, audience precision, and performance to TV advertising. We also announced an integration between Disney's real-time ad exchange and Amazon DSP. This collaboration allows advertisers to gain direct access to Disney's premium inventory across platforms like Disney+, ESPN, and Hulu, while allowing them to leverage insights from both companies. When advertisers work with Amazon, they're not just buying ad space. They're benefiting from exceptional programming, innovative technology, and unrivaled signals, measurement, and audience development that provides strong relevancy for consumers and return on investment for brands. Moving on to AWS. In Q2, AWS grew 17.5% year over year and now has over a $123 billion annualized revenue run rate. We continue to help organizations of all sizes accelerate their transition to the cloud, signing new agreements with companies including PepsiCo, Airbnb, Peloton, NASDAQ, London Stock Exchange, Nissan Motor, GitLab, SAP, Warner Brothers Discovery, 12 Labs, FICO, Iberia Airlines, SK Telecom, and NatWest. In the rapidly evolving world of generative AI, AWS continues to build a large, fast-growing, triple-digit year-over-year percentage, multi-billion-dollar business with more demand than we have supply for at the moment. A few points to make. First, on the hardware side, our custom AI chip, Trainium2, is landing capacity in larger quantities and has impressively emerged as the backbone for Anthropic's newest generation Claude models and many of our most essential offerings like Amazon Bedrock. We've also launched Amazon EC2 instances powered by Nvidia Grace Blackwell superchips, AWS's most powerful Nvidia GPU accelerated instance. Second, in Bedrock, we've recently added Anthropic's Claude 4, and it's the fastest growing model ever in Bedrock. We've also continued to see strong adoption of Amazon Nova, our own frontier model, and it's now the second most popular foundation model in Bedrock. New features in Nova allow customers to customize their Nova models in ways they can't on other foundation models, allowing organizations to infuse these models with their unique expertise while optimizing for cost and speed. As people have become excited about building agents, they're realizing they lack the tools to build them. In May, we released Strands, an open source way to more easily build agents that's taken off with a wide range of customers with already 2,500 stars on GitHub and over 300,000 downloads on PyPI. Customers are also struggling with deploying agents into production in a secure and scalable way. It's holding up enterprises scaling agents. To help solve that problem, Bedrock just released Agent Core. Agent Core is a set of building blocks that gives customers the industry's first secure serverless runtime to provide both synchronous and asynchronous execution, agent identity and boundaries, a memory service, a gateway that translates services to MCP-compatible interfaces, built-in code execution and web browser tools, and an observability service. Customers are excited about Agent Core, and it frees them up to start deploying agents more expansively. Third, you're starting to see AWS release more powerful applications at the top layer of the AI stack. AWS Transform is an AWS agent that dramatically reduces mainframe modernization timelines from years to months, completes VMware to EC2 conversions up to 80 times faster, It makes it simple to move from .NET Windows to .NET Linux implementations, reducing licensing costs for .NET applications by up to 40%. We've also just released Curo, our new agentic integrated development environment coding agent. There's a lot of buzz around Curo, with several 100,000 developers using or requesting access in the first couple of weeks, 100,000 used in the first 5 days of the preview. What struck a chord for developers is that Curo allows them to do vibe coding, where developers use natural language to chat with a coding agent to build code. But unlike other coding agents where developers don't really have any structure to build on top of, Curo allows developers to use natural language to build a spec, and then automatically updates that spec as they continue to vibe code or interact with Curo. This makes it much easier to go from prototyping to production. Customers also like Curo's event-driven agent hooks that act like an experienced developer catching things developers might miss. When developers save a React component, hooks update the test file. When they modify API endpoints, hooks refresh README files. When they're ready to commit, security hooks scan for leaked credentials. It's still very early for Curo, but it seems clear we're onto something customers love, and Curo has a chance to transform how developers build software. I say this frequently, but remember that 85 to 90% of worldwide IT spend is still on premises versus in the cloud. In the next 10 to 15 years, that equation is going to flip, further accelerated by companies' excitement for leveraging AI. So AWS's significantly broader functionality, stronger security and operational performance, and much deeper experience helping enterprises modernize their infrastructure bodes well for the AWS business moving forward. We're also seeing momentum in a number of our other areas across Amazon. I'll mention just a few. We're excited about our progress with Alexa Plus, our next-generation assistant powered by generative AI. We've been rolling out early access to U.S. customers to start. Millions of customers have access now. We're seeing very positive feedback and will continue to iterate on the experience. We've recently completed our third successful launch of Project Kuiper. We haven't launched this service commercially yet, but already have an impressive amount of enterprise and government customers who have signed agreements to use Kuiper. In Prime Video Live Sports, our first season of NASCAR drew about 2 million viewers per race and the youngest audience among NASCAR broadcasters in more than a decade. We've recently announced our stellar broadcasting crew for our upcoming first NBA season, including Ian Eagle, Stan Van Gundy, Kevin Harlan, Dwayne Wade, Taylor Rooks, Blake Griffin, Dirk Nowitzki, Steve Nash, and Candace Parker. We also announced Denis Villeneuve, an Academy Award nominee, as the director for the next James Bond film. James Bond is in the hands of one of today's greatest filmmakers, and we cannot wait to get started on 007's next adventure. Finally, we continue to be very pleased with the growth and resonance of Amazon Pharmacy, as it's grown 50% year to date on an already significant size base. A lot of good things happening across the company. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Let's start with our top-line financial results. Worldwide revenue was $167.7 billion, a 12% increase year-over-year, excluding the impact of foreign exchange. Foreign exchange had a $1.5 billion favorable impact to revenue in the quarter, as foreign currencies generally strengthened versus the US dollar. As a reminder, our Q2 revenue guidance had anticipated an unfavorable impact of approximately 10 basis points or $100 million. Worldwide operating income was $19.2 billion, which was $1.7 billion above the high end of our guidance range. Across our segments, we continue to prioritize cost-effective innovation that delivers value for our customers. In the North America segment, second quarter revenue was $100.1 billion, an increase of 11% year-over-year. International segment revenue was $36.8 billion, an increase of 11% year-over-year, excluding the impact of foreign exchange. Worldwide paid units grew 12% year-over-year. We remain focused on inputs that matter most to our customers. In the second quarter, we saw broad-based strength across our key performance metrics. This includes sharp pricing and more in-stock availability, as well as record delivery speeds for Prime members. Our millions of global sellers continue to be an important contributor to our vast selection. This helps customers find the items they need and does so at a competitive price. Our investment in tools, services, and fast delivery speeds help our selling partners reach more customers and further scale their businesses. In Q2, worldwide third-party seller unit mix was 62%, the highest ever, up on 100 basis points from Q2 of last year. We're also closely monitoring the macroeconomic environment, including the impact of tariffs. As Andy mentioned, our Q2 plan factored in a range of assumptions, not all of which materialized. We will continue to consider a range of assumptions going forward. Shifting to profitability, North America segment operating income was $7.5 billion, an increase of $2.5 billion year on year. North America operating margin was 7.5%, up 190 basis points year over year. International segment operating income was $1.5 billion, up $1.2 billion year over year. International operating margin was 4.1%, up 320 basis points year over year. We're pleased with the strong execution of our operations teams and the positive experience they delivered for customers. In Q2, we saw productivity gains in our transportation network, driven by improved inventory placement, strong leverage on high unit volumes, and higher levels of in-demand inventory from both first-party and third-party selling partners. These factors contributed to faster delivery speeds and lower costs. Outbound shipping costs were up 6% year over year and continue to grow at a meaningfully slower pace than unit growth, which, as I mentioned earlier, was up 12% year over year. We're committed to initiatives that further improve our cost structure. Strategic inventory placement drives multiple benefits, including better in-stock availability, shorter delivery routes, and faster customer delivery times. When we optimize inventory location, we can consolidate more items per package, reducing packaging materials and costs. To achieve this, we will continue to improve upon our inbound network, expand our U.S. same-day delivery facilities, including in rural communities, and implement robotics and automation across our facilities. While year-over-year improvements in operating margin may fluctuate, we have a purposeful strategy to achieve sustained progress over time. Shifting to advertising, advertising revenue grew 22% year over year, driven by sponsored products as we saw strong traffic in our stores. Advertising remains an important contributor to profitability in the North American international segments. Our full funnel advertising approach of connecting brands with customers is resonating. Moving next to our AWS segment, revenue was $30.9 billion, an increase of 17.5% year over year. AWS now has an annualized revenue run rate of more than $123 billion. During the second quarter, we continue to see growth in both our generative AI and non-generative AI businesses. As companies turn their attention to newer initiatives, bring more workloads to the cloud, restart or accelerate existing migrations from on-premise to the cloud, and tap into the power of generative AI. AWS operating income was $10.2 billion. We did see AWS segment margins decline from a record high of 39.5% in Q1 to 32.9% in Q2. The largest quarter-over-quarter driver of the decrease, or about half, is due to the seasonal step-up in stock-based compensation expense, driven by the timing of our annual compensation cycle. AWS margins also saw headwinds from higher depreciation expense, as well as unfavorable impacts from year-over-year fluctuations in foreign exchange rates. The depreciation expense is a result of our growing investments in capital expenditures in AWS. As we've said in the past, we expect AWS operating margins to fluctuate over time, driven in part by the level of investments we are making at any point in time. We will continue to invest more capital in chips, data centers, and power to pursue this unusually large opportunity that we have in generative AI. Now turning to our cash CapEx, which was $31.4 billion in Q2. We expect Q2 CapEx to be reasonably representative of our quarterly capital investment rate for the back half of this year. AWS continues to be the primary driver as we invest to support demand for our AI services and increasingly in custom silicon like Trainium, as well as tech infrastructure to support our North America and international segments. Additionally, we continue to invest in our fulfillment and transportation network to support growth of the business, improve delivery speeds, and lower our cost to serve by investing in same-day delivery facilities as well as robotics and automation. Collectively, these investments will support growth for many years to come. Moving on to our third quarter financial guidance. As a reminder, our guidance considers a range of possibilities which take into consideration Q2 results, trends we see quarter to date, and expectations around the macroeconomic environment, including tariffs. Q3 net sales are expected to be between $174 billion and $179.5 billion. We estimate the year-over-year impact of changes in foreign exchange rates based on current rates, which we expect to be a favorable impact of approximately 130 basis points. As a reminder, global currencies can fluctuate during the quarter. Q3 operating income is expected to be between $15.5 billion and $20.5 billion. In this dynamic environment, we'll focus on what matters most: delivering exceptional customer value through broad selection, competitive prices, and unmatched convenience. We'll remain focused on driving a better customer experience and believe putting customers first is the only reliable way to create lasting value for our shareholders. With that, let's move on to your questions.
Thank you. At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your keypad. We ask that when you pose your question, you pick up your headsets to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touch-tone telephone at this time. Please hold while we poll for questions. Thank you. Our first question comes from Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks so much for taking the questions. I have two. First, can you just help us understand with some more granularity how tariffs are being absorbed across suppliers, Amazon, and consumers, and whether you anticipate any change going forward? And then second, on AWS, we're seeing significantly faster cloud growth among the number 2 and 3 players in the space. I totally appreciate that AWS is coming off of a bigger base. But beyond that, do you think the output gap is due more to customer demand or infrastructure supply or both? Thanks.
Yeah, I'll take both those. I'll start with the tariffs. I think what we said a number of times, and we still believe it, is we just don't know what's going to happen moving forward. It's hard to know where the tariffs are going to settle, particularly in China. It's hard to know what will happen when we deplete, some of the pre-buys that we did on our own first-party retail, and then some of the forward deploying that we saw of our third-party selling partners. And when, if costs go up over time, we're unsure at this point who's going to end up absorbing those higher costs. What we can tell you is what we've seen so far in the first half of the year. And in the first half, we just haven't seen diminished demand, and we haven't seen any kind of broad-scale ASP increases. And so that could change in the second half. There are a lot of things that we don't know, but that's what we've seen so far. On the question on AWS, the first thing I'd say is, it's as you said, Doug, in your question, year-over-year percentages and growth rates are always a function of the base in which you operate. And we have a meaningfully larger business in the AWS segment than others. I think the second player is about 65% of the size of AWS. And when we look at the results over the last number of quarters, there's some times where as far as we can tell, we're growing faster than others, and sometimes others are growing faster than us. But it's still like if you look at the second place player you're talking about, it's still a pretty significant segment, market segment leadership position that we have. And regardless, these are all really just moments in time. The last week is a moment in time too, where
the reality of what really matters is what customers' experiences are in operating on these platforms. And if you look at what matters to customers, what they care a lot about what the operational performance is, what the availability is, what the durability is, what the latency and throughput is of the various services. And I think we have a pretty significant advantage in that area. They care a lot about security. If you have data that matters, and for most companies, they're putting data that they really care about in the cloud, the security and the privacy of that data matters a lot. And there are very different results in security in AWS than you'll see in other players. And you just look at what's happened the last couple months. You can just see kind of adventures at some of these players almost every month. And so very big difference, I think, in security. And then I think a really significant difference in functionality, where not just in the core infrastructure do we have a lot more functionality in our services, but I think if you look at our end-to-end offering in AWS, in AI, it's, from the bottom of the stack all the way to the top, it's pretty different. And so, I feel good about the inputs and the services that we're offering to customers across AI as well as non-AI. And, we have more demand than we have capacity right now. So we could be doing more revenue and helping customers more. And we're working very hard on changing that outcome and how much capacity we have. But it's still you look at the business, it's a $123 billion annual revenue run rate business, and it's still early. I mean, how often do you have an opportunity that's $123 billion of annual revenue run rate where you say it's still early? It's a very unusual opportunity that we're very bullish about.
Thank you. Our next question comes from Mark Mahaney with Evercore. Please proceed with your question.
Okay, I'll stick with AWS to start it with. Could you just disclose the backlog number? And then in the past, I know you've talked about these supply constraints and hoping that they will sort of resolve themselves by the back half of the year. Is that still your intention? Anything that suggests that the supply constraints are going to get resolved earlier or later? And then a long-term question on Alexa Plus, and I've been experimenting with it for a while. Just Andy, when you think about the potential that has in terms of increasing engagement, maybe tapping into some services revenue, advertising, maybe a little bit more retail sales per household, you're just reducing friction. Just talk about how, from a financial perspective, how you think that could play out, how we would maybe see that in the numbers. Thank you very much.
Hey, Mark, this is Dave. I'll just start off to give you the backlog figure. So at the end of the quarter, at June 30, that was $195 billion. So that's up about 25% year over year.
On the supply constraints as it relates to AWS and what we see there, as I mentioned, we have more demand than we have capacity at this point. And I think that, and you see, some of the constraints, they kind of exist in multiple places. The single biggest constraint is power. But you also see constraints off and on with chips, and then some of the components that, once you have the chips to actually make the servers, sometimes you have new generations of chips that are a little bit later than they're supposed to be, and sometimes you get the chips, and the yield you get in making servers isn't what you expect when you get to ramp. So there are a bunch of those pieces today that we're working on. It's really true across the industry today. I don't believe that we will have fully resolved the amount of capacity we need for the amount of demand that we have in a couple quarters. I think it will take several quarters, but I do expect that it's going to get better each quarter, and I'm optimistic about that. I think on the Alexa question, I think I'd start by saying the Alexa Plus experience is so much better than I think our prior Alexa experience. She's much more intelligent than her prior self. She's much more capable. And I would say, unlike the other chatbots that are out there today who are good at answering questions but really can't take any action for you, Alexa Plus can take a lot of action for you, which is very compelling. So I can ask Alexa to play music for me, or play video for me, or move my music from one device to another. Or if I'm listening to a song that's in a movie, I can ask
Alexa Plus to actually put that movie scene on that of a song I'm playing, and it'll put it on my Prime Video on Fire TV. Or if I have guests coming over, I can say, Alexa, draw the curtains, put the light on the porch and the driveway, increase the temperature by 5 degrees, and put on music that would be great for a dinner party. And she does all that just for using natural language. So she can take a lot of actions, and it's compelling. And what we see so far, we've been rolling out Alexa Plus, starting in the U.S. It's with millions of customers now. The rest in the U.S. coming in the next couple of months, and starting the international rollout more broadly later in the year. And customers really like the experience. They recognize how much better it is than what it was before. The ratings are very high. The usage is much more expansive than what they were using before. The number of calls they're making is meaningfully higher. And I think there are a number of different areas where we'll see benefit. I think first, if you build the world's best personal assistant, that has a lot of utility for customers, and therefore it gets used a lot. So it means everything from people are excited about the devices that they can buy from us that has Alexa Plus enabled in it. People do a lot of shopping, and it's a delightful shopping experience that will keep getting better. I think over time there will be opportunities, as people are engaging in more multi-turn conversations, to have advertising play a role to help people find discovery, and also as a lever to drive revenue. And I think over time you could also imagine, as we keep adding functionality, that there could be some sort of subscription element beyond what there is today. Today, Prime members get Alexa Plus for free, and non-Prime members pay $19.99 a month for Alexa Plus. So I think it's still very early days, but we're very encouraged by the experience we're providing, and you can bet we're going to be iterating on it constantly.
Thank you. And our next question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Thanks for taking the questions. I guess first off, with respect to the international segment and the progress in both revenues and margins, I was hoping you could add maybe some color on the drivers of each of those and the sustainability of the improved efficiency in those markets. And then, Andy, you mentioned Kuiper. We haven't heard as much about that of late, so maybe if you could review where things stand relative to next year's launch target, timing of the service rollout, and maybe any perspective you have on the longer-term ambitions for the satellite network. Thank you.
Thanks, Colin. This is Brian. I'll start with the international segment question. So, very strong quarter for international segment, both on revenue growth and also on operating margin. Operating margin was up 320 basis points year over year to 4.1%. And if you look, that's the continuation of a strong progression we've seen quarter by quarter over the last 10 quarters. In total, we've seen an increase of close to 700 basis points during that time period. So really, it's a tale of two pieces of two segments, sections within international. One is the established countries like UK, Germany, and Japan, already at similar margin profiles to the U.S. So we'll, as they continue to grow, their contribution to profit will grow over time, and that's what we're seeing. In the quarter, we saw strong productivity in our transportation network in those countries, much like we saw in the U.S., and that's led to higher units per package and faster delivery speeds at lower cost. So again, the theme of lower cost to serve and also increased speed and better selection for customers continues to grow internationally as well. In our emerging countries, we're pleased with the progress we're making there. We've launched 8 countries, of course, in the last 5 years, and they're all varying degrees of upfront investment and different point in times in their journey to profitability. But they're all making very nice improvements quarter over quarter in growing selection, adding Prime members, and expanding our customer offerings. So I think what you're seeing again is sustained improvement in those areas. Feel very good about it. The established countries are continuing to grow and develop and very much look like the United States. And the emerging countries, again, are all very different stages of growth right now.
On the Project Kuiper question, so Project Kuiper is our low Earth orbit satellite constellation that we're putting up and launching. And, there's 400 to 500 million households worldwide who don't have broadband connectivity. And it means they can't do a lot of the things we take for granted, like education online or business online or shopping or entertainment. There is really a digital divide, and it's much needed. And it's also true for enterprises and for governments that they have assets or needs to have visibility or connectivity that they can't get today, given the lack of broadband in a bunch of places around the world. So there's a high need. I would say that as we get our constellation into space, there will really be two players that have what I would consider the modern technology in low Earth orbit satellite. One is the incumbent in the market today, and the second will be Project Kuiper. I think that we will have a pretty meaningful differentiation here in performance. If you look at the performance of what I expect on the uplink and downlink, I think Project Kuiper will be advantaged. I also think the pricing is going to be very compelling for customers. And then I think if you think about the three key customer segments who want low Earth orbit satellite: consumers, enterprises, and governments. We have very strong relationships with all three customer segments, given our consumer businesses and our AWS business. And I think if you think about enterprises and governments, a lot of what they want to do when they take the data down from space is they actually want to put it into a cloud to do analysis, analytics, and AI and various operations on top of it. And the fact that Project Kuiper and AWS are so seamlessly connected is very attractive to enterprises and to governments. And I'm kind of amazed. We haven't launched Project Kuiper yet, but the number of enterprise and government agreements that have been signed already to use Project Kuiper is impressive. So we're working very hard to get the satellites into space. We have some delays with some of the rocket providers, but we have most of the available rocket launches over the next couple of years, and we're very hopeful to get the service into commercial beta later this year, early next year.
Thank you. And our next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. Andy, I have two for you on AWS. They're a little tough, but I'm gonna throw them at you. So there is a Wall Street finance person narrative right now that AWS is falling behind in Gen AI with concerns about share loss to peers, et cetera. Can you just sort of address that? What is your rebuttal to that? And talk to us about your and the team's most important focal points, just to ensure that AWS stays on the knife's edge of innovation versus hyperscaler peers. And then secondly, I know AWS is a big business, but is there any reason to assume it shouldn't accelerate in the back half and into 26, given the size of the opportunity and all of the Gen AI capabilities going to sort of come to us in the next 12 months?
Yeah. So on the first one around AI, the first thing I would say is that I think it is so early right now in AI. If you look at what's really happening in the space, you have it's very top heavy. So you have a small number of very large frontier models that are being trained that spend a lot on computing. A couple of which are being trained on top of AWS, and others are being trained elsewhere. And then you also have, I would say, a relatively small number of very large-scale generative AI applications. The one category would be chatbots, with the largest by a fair bit being ChatGPT. But the other category being really, I'll call it coding agents. And so these are companies like Cursor, Vercel, and Lovable, and some of the companies like that. Again, several of which run significant chunks on top of AWS. And then you've got a very large number of generative AI applications that are in pilot mode, that are in pilots, or that are being developed as we speak. and a very substantial number of agents that also people are starting to try to build and figure out how to get into production in a broad way. But they're quite early, and many of them that are out there are, they're significant, but they're just smaller in terms of usage relative to some of those top-heavy applications I mentioned earlier. We have a very significant number of enterprises and startups who are running applications on top of AWS's AI services. And then, but they're all, again, like the amount of usage and the expansiveness of the use cases and how much people are putting them into production and the number of agents that are going to exist, it's still just earlier stage than it's going to be. And so then when you think about what's going to matter in AI, what are customers going to care about when they're thinking about what infrastructure to use, I think you kind of have to look at the different layers of the stack. And, I think for those that are, both building models, but also just if you look at where the real costs are, they're going to ultimately be in inference. Today, so much of the cost is in training because customers are really training their models and trying to figure out how to get applications into production. But at scale, 80 to 90% of the cost will be in inference because you only train periodically, but you're spitting out predictions and inferences all the time. And so what they're going to care a lot about is they're going to care about the compute and the hardware they're using. And, we have a very deep partnership with Nvidia and will for as long as I can foresee. But we saw this movie in the CPU space with Intel where customers are hankering for better price performance. And so, we built, just like in the CPU space, where we built our own custom silicon in building Graviton, which is about 40% more price performant than the other leading x86 processors. We've done the same thing on the custom silicon side in AI with Trainium. And our second version of Trainium 2 has really, it's become the backbone of Anthropic's, next Claude models they're trading on top of, and it's become the backbone of Bedrock and the inference that we do. So I think a lot of the inference, it's about 30 to 40% better price performance than the other GPU providers out there right now, and we're already working on our third version of Trainium as well. So I think a lot of the, compute and the inference is going to ultimately be run on top of Trainium 2, and I think that price performance is going to matter to people as they get to scale. Then I would say that that middle layer of the stack are really, it's a combination of services that customers care about to be able to build models and then to be able to leverage existing leading frontier models and then build, high quality generative AI applications that do inference at scale. And, we see it for people building models. They continue to use SageMaker AI very expansively. And then Bedrock, when you're leveraging leading frontier models, is also growing very substantially. And, as I said in my opening comments, the number of agents at scale is still really small in the scheme of what's going to be the case. But part of the problem is it's actually hard to actually build agents, and it's hard to deploy these agents in a secure and scalable way. And so I think the launches we made recently in Strands that make it much easier to build agents, and then Agent Core that make it much easier to deploy at scale and in a secure way, are being very well received, and customers are excited. It's going to change what's possible on the agent side. And then I think that you've got a very large number. I mean, remember, 85 to 90% of the global IT spend is still on premises. If you believe that equation is going to flip, which I do, and we do, you have a lot of legacy infrastructure that you've got to move. These are mainframes. These are VMware's instances. And, when we build agents like AWS Transform that make it much easier to move mainframes to the cloud, much easier to move VMware to the cloud, much easier to move .NET Windows to .NET Linux to save money. Like, those are compelling for enterprises, or things like Kiro that allow customers to develop in a much easier way and in a much more structured way, which is why I think people are excited about it. So I think I really like the inputs in the set of services that we're building in the AI space today. Customers really like them, and it's resonating with them. I still think it's very early days in AI and in terms of adoption. But the other thing I would just say is that remember, because we're at a stage right now where so much of the activity is training and figuring out how to get your generative AI applications into production, people aren't paying as close attention as they will in making sure that those generative AI applications are operating where the rest of their data and infrastructure is. Remember, a lot of generative AI, inference is just going to be another building block like compute, storage, and database. And so people are going to actually want to run those applications close to where the other applications are running, where their data is. There's just so many more applications and data running in AWS than anywhere else. And I'm very optimistic about, as we get to a bigger scale, what's going to happen for AWS on the AI side. And I think we have a set of services that is unique, top to bottom in the stack. I think on the last part about what do we expect with respect to acceleration, we don't give guidance by segment, so I'm not going to try and give you guidance. But I do believe that the combination of more enterprises who have resumed their march to modernize their infrastructure and move from on-premises to the cloud, coupled with the fact that AI is going to accelerate in terms of more companies deploying more AI applications into production that start to scale, coupled with the fact that I do think that more capacity is going to come online in the coming months and quarters, make me optimistic about the AWS business.
Thank you. And the next question comes from the line of Ron Josey with Citi. Please proceed with your question.
Great, thanks. Thanks for that, Andy. That was really helpful. Maybe taking that same question, but focusing internally on Amazon. I think you penned an article or a blog post back in June just talking about the ability or potential with Gen AI agents and improving efficiencies and speed to market internally. So would love to hear your thoughts as you think about how Amazon is adopting generative AI internally, how perhaps you've seen improving speed to market as a result of everything you've just talked about. Thank you.
Yeah, I think that AI is the biggest technology transformation of our lifetime, which is saying a lot because even in some of our relatively short lifetimes, we've been through the cloud, mobile, and the internet itself. But I think it's going to be the biggest transformation technically in our lifetime. And I think it's going to not only change every customer experience that we know and enable customer experiences we really only dreamed about before, but it's also going to change very substantially the way we work. And if you think about it, the way that we do coding, the way that we do analytics, the way that we do research, the way that we do finance, and measure finance. I mean, really, the way we do business process automation, the way we do customer service, every single area that I can think of in the way we work is likely going to be impacted in some meaningful way by AI. And I think when you have a big shift like that, you have two macro choices. You can either decide that you're going to embrace it and you're going to help shape it, and you're going to figure out how to build the right tools to allow you to take advantage of the technology, or you can wish it away and have it shape you. And the posting that you're referencing, Ron, that I made was just really being clear with the team that we're going to pursue that former approach. We are going to embrace it, and we're going to try and shape it. And so we have we have a number of tools and agents that we've built already inside the company. And these are things like, if you think about Kiro and the opportunity to have coding agents do a lot of the coding, that's very compelling. It's going to allow our teammates to be able to start from a more advanced starting spot and to be able to invent for customers much more quickly and much more expansively. If you think about services like Connect, which is our AWS service that does call center software, that has a lot of AI built into it that changes the productivity of all your customer service agents. And you can just imagine across the board the types of things we're going to do to make it easier to get software out, to build high quality software, to do operations, QA, to automate a lot of the business process coordination that happens inside the company. We're going to work on a whole bunch of those areas to allow ourselves primarily to be able to invent for customers much more quickly and expansively. But also, I think it's going to make all of our teammates' jobs much more enjoyable because they won't have to do as many of the rote parts of the job that we all do right now. And they're going to be able to own more pieces of what they're trying to solve for customers. And we want deep owners that want to own as much end-to-end as possible.
Thank you. And our final question will come from the line of Justin Post with Bank of America. Please proceed with your question.
Great. Thanks. I'll just ask on the revenue guidance. It looks pretty robust growth in the third quarter. I know you won't say whether AWS is expected to accelerate, but could you talk about some of the drivers and what kind of tariff and other contingencies you've put in there, and then maybe any thoughts on how you're thinking about how the Q4 is shaping up? Thank you.
Yeah, hi, Justin. This is Brian. I'll take this one. Yeah, we've got it to 174 billion to 175 billion. And 179.5 billion, a typo. We feel good about the growth rate in Q2 that we had and the acceleration in a number of areas, including units. And, we had a very successful Prime Day earlier this month. So, there is uncertainty on where tariffs will settle and maybe the ultimate impact on consumers, as Andy mentioned earlier. But, we feel really good about the key inputs we control: price, selection, and convenience. We've talked about delivery speeds increasing. We've talked about selection increasing, high in-stock levels, well-dispersed inventory close to customers. So we think that all works in our favor. So I would say we're cautiously optimistic. I'm not going to give any guidance for Q4 at this time, but we'll talk about that next time.
Thanks for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and we look forward to speaking with you again with you.
All right. That was an amazing earnings call. Probably one of the best I've seen I've listened to in a long time. Just kidding. That was boring. I mean, that was boring, but that's then again typical Amazon.
I do want to say that the second and last question was pretty good, or at least the question itself. I don't know about the answer where the analyst was like, the Wall Street is kind of saying you guys are slowing down in AI. What do you have to say about that?
Yeah, but the answer was again 30 minutes long, so I forgot what was actually like. There were 2 good questions, but then the answers were like, hello, this is an investor earnings call, not an investor day. But yeah, Amazon, let me just pull up what it's doing right now. Down to $217, which means it's down 7.3%. 7.3% down right now. Which means we are back to prices not seen since last month. It wasn't wasn't the most exciting call. But yeah, we're now at the 50-day moving average, it seems. The 200-day sits at 205. Would be very interesting to see if we can actually get there. I could see quite a lot of people wanting to buy at these prices. Look, Amazon, it's not the first nor the last time where you're going to... First of all, the quarter was fine, right? I think AWS met expectations, but didn't blow it out of the water, which is what they wanted to, the market wanted to see. Comments on AWS, they didn't want to give future growth numbers. Analysts wanted to know, they didn't give them.
They just said, right, the market is huge. We're still in early innings. We don't really need to invest too much right now, because what's really going to be a driving force is AI agents. Right now, it seems like it's more kind of like that training compute. And it's like we don't really need to necessarily go for that, as the real market is going to be that inference space. And that's one that might be expected later. So that's where we're investing now. We didn't have to invest in the past. Wonder if that's an excuse or a truth, right? That's a whole different topic of discussion, but it does make sense on a really top level overview, right?
Yeah. Plus backlog. They did say that backlog was up 25% year over year to 190. What is it? $195 billion. So that's good. I think the last number we got, what did I show you? Was let's see. 189. So that's up by 6 billion for quarter over quarter. Okay. Which actually is not that bad, because AWS quarter over quarter did only grow 800 million.
What else did we heard? I mean, they are constrained on compute, but that's something we keep hearing from all the other players. One thing that I'm gonna have to re-listen to, Neil, is they talked a little bit of kind of like something didn't meet their yield expectations on kind of server making. Were they talking about their Trainium chip? If so, maybe that could be seen as a little maybe bearish flag for Marvell. But at the same time, in another question, I think they mentioned that they're going to continue to invest on their own ASIC solution. So that's just the sucky part about these live calls is I'm definitely going to want to read the transcript a lot again, or listen to the call again and see if those things are happening, because I want to hear they talk something about yields and AI servers and kind of their ASIC supply and ASIC demand as well.
For those that are wondering, this is basically what AWS growth looks like. Is this the most updated one? So it is growing. I actually see that we are seeing a small acceleration. It seems 17.5% based on the numbers here on fiscal.ai. But I guess analysts in the market wanted to see maybe more optimism about definitely short-term growth. Because they did mention, look, we've seen Microsoft, we've seen Google, and now we're seeing your numbers. What are you seeing? But Amazon has always been the player that looks at the long-term game. They're not a company that looks at next quarter or even the next couple of quarters. They look at the next couple of years and decades ahead, which is why you have seen this basically. Let me pull up all of these things right here.
Neil, do you think this earnings drop is an overreaction, or do you think it's maybe the market was just expecting a little bit too much? What are you thinking about this 5% dip on Amazon?
You mean 7%
dip on Amazon?
I think it's high expectations plus comparisons to Microsoft and Google. But then you would think that Google would be up right now, but they're not. Microsoft is up 1%. Google is not. Google is not up. So it's a bit of both. Again, like I said, Amazon was up 49% or so since the April lows, have been going up quite a lot more recently. And so, I mean, it is still my number one position in the core portfolio. Meta, of course, if Meta continues like this and Amazon drops a little bit more, Meta is the number one. But it's an amazing company. I mean, it's if we're talking about competitive advantages, you look at Amazon and you see that. So yeah, maybe people are selling Amazon to buy Figma, because apparently Figma is up 25% after hours.
No freaking way.
So I guess that's the play. Buy memes, sell Amazon, and sell Google also.
And Google, yeah.
No, but yeah. I mean, did you hear anything specific on the call that said, "Oh, actually not that bad," or should have said something else?
No, like I mentioned, I mean, for me, I really like they talk about capital expenditure. They did about 20 something in quarter 1, and here they did about 32. They mentioned 30. I forget what the actual number. It was closer to 31, 32, and they mentioned that rate is that value is expected to at least continue for this year. So if you do 30, 30, 30, that's 90 plus 20. You're somewhere around 115, 120 in capital expenditure for this year, which was a bit higher compared to what they gave us last quarter. I think last quarter was closer to 105, if I remember the number correctly. So, and yeah, that's a semiconductor investor. That's really what I like to hear. And then, like I mentioned earlier, I would love to hear a little bit more on or reread some of their AI server yields that they were discussing. Outside of that, nothing. And would love to hear that question of why about the market seeing AWS as a weaker play right now in the cloud space. And I would just want to redigest the information that the CEO said, because it was a lot. Like you mentioned, a lot of these answers kind of went off a longer tantrum. Typically, what we see with Jensen does the same thing. So it's like it's one of those answers you're going to have to reread a few times to really understand what management was discussing.
Yeah, I'm trying to see if someone wrote something on X from that quote. Let's see if I'm seeing something. I mean, if Google did this type of earnings call, I think the stock would have been down 10%, if not more.
Oh, yes, for sure. 100%. Google dropped this. Google's PE of 10 or something.
Let's see if someone wrote a quote. I don't think so. Actually, maybe I can show this already. Just the margins. They explained it, right? It's they said it's SBC expense for the quarter. That's the reason why we have seen. Let's see. I have here AWS quarterly. Yeah, so you see the drop here. AWS operating margin 32.9%, down from the 39.5%. So if I remember correctly, they said it's SBC impacting it for the quarter. But yeah, what was the second reason? So are influenced by investment cycle. So we expect AWS operating margins to fluctuate over time, driven in part by the level of investment we're making at any point in time. Plan to bring on an increasing amount of capacity in the back half of the year. This is something they mentioned actually in Q1. So yeah.
Sorry, I was reading this comment, Roberto. Jose, if you want us to apply, we can. I feel bad about calling you a weak-handed trader earlier. We can buy more Google and Amazon. No, now you got me. I felt like we need to stick to it now.
Yeah, no. We need to stick. I mean, I read a little bit of the transcript for Applied, and it's quite bullish actually. They were quite bullish on the future. I mean, imagine starting at the end of this year, starting next year, they will start generating even more and more revenue. They are in talks with more companies as well. So $733 million in revenue just from CoreWeave per year is quite big. Is quite big, yeah. I do wonder if, maybe that's going to be for the next 5-10 minutes or so, but I think we'll leave it for another time. Depreciation FX rate as well. Yeah, depreciation probably as well. FX rates. Okay, so I guess it's a mix: SBC, depreciation, FX rates, and whatever. But yeah, the answers were way too long. Way too long.
I'm sorry, Neil. I think you need a too long. Don't watch, don't listen, don't read.
No, I mean, there was this one question, and the guy was going on for 10 minutes. I'm like, I didn't ask you about Alexa's preferred vegetables. Like, well, what the heck was that? But okay, I mean, it's Amazon. It's not like we're talking about a shitco here that will disappear tomorrow. They probably know what they're doing. Backlog did grow 25%, so I guess that's the growth rate that we should be expecting for Amazon, closer to 25% instead of the 17.5.
One thing I'm gonna want to try to do, and maybe we can both and just share it with each other. The backlog with all these big players, so like that we can just kind of keep a track on them. And I think it'll be good information to always have on top and be able to share.
Yeah, no, for sure. CapEx of the last 12 months was 108 billion.
Mm-hmm.
Noise. Let me check before we end what Reddit is doing. Last time we checked was up 20, still up 16.9%. Coinbase down 7.3, and Le Roku.
What is Apple doing after the call?
What do you say?
Up, because yeah. They said something about AI.
Up 3.1.
Staying around. Yeah.
Up 3.1. But apparently they didn't want to, Timmy didn't want to talk about LLMs and things like that. Like, we don't want to reveal our strategy. What strategy? There is no strategy.
All right, Neil, I do have to go. I'm going to go have dinner with the little one and the wife.
I'm done. I'm done for the day. So yeah, I mean, money's flowing into Figma. Money's flowing out of Amazon. That's the only answer and the explanation, I'd say. Apple's earnings were fire. Yeah, I mean, when the bar has been set so low, I guess it's fine. It's fine. So yeah, I don't know. We won't be back tomorrow. I might, but maybe not, depending on the mood. But we will be back on Monday.
Yeah, for sure on Monday.
Monday is a big day. Tuesday is a very big day. I think Monday is Palantir and Tuesday is AMD.
Oh, nice.
So yeah,
very nice. Yeah.
Next week is a nice busy week as well. So thank you all for joining us in this lovely live stream. We'll see each other either tomorrow or, well, actually you will see us probably on our own channel every single day, so you won't miss us that much. But yeah, live streams back